Welcome to today's explainer. We're doing an incredibly detailed deep dive into the GST filing ecosystem. Look, if you deal with business compliance, you already know the deal. Tracking the life cycle of a single data point from the literal second an invoice is cut all the way to the final tax payment, well, it can feel like navigating an absolute maze. So let's trace the exact journey of a GST invoice together and bring some real clarity to the chaos. But right before we get deep into the weeds, let me hit you with an interview checkpoint right out of the gate. Is GSTR2B a static return, meaning once it's generated, it's locked in and never changes? Or is it a dynamic, fluctuating return? Think about your answer for a second. A lot of highly seasoned professionals are actually getting this totally wrong right now because of some massive portal updates. Lock in your answer because we are going to definitively solve this mystery very shortly. All right, here is our roadmap for this session. We'll start with the structure of GST returns, move into GSTR1 and outward supply, decode the game of IMS and 2B, see how it settles in GSTR3B and tax payment, and finally, look at a pretty wild real-world fraud alert regarding credit notes. Okay, part 1, structure of GST returns. So the absolute first fork in the road for any business is deciding your filing frequency. If your business has a turnover up to 5 crore rupees, the government offers you the QRMP scheme. That's quarterly return, monthly payment. It's really meant to ease the compliance burden for smaller businesses. However, if you cross that 5 crore limit, or you simply decide you don't want to opt in, you fall straight into the standard monthly filing bucket. And that means your GSTR1 and GSTR3B have to be filed every single month, no exceptions.
But here is where people make a massive, absolutely critical mistake defining that 5 crore limit. You see, the GST framework looks at aggregate turnover, and that is calculated PAN-wise, not per individual GSTIN. Think of it like this. Say you have a 4 crore business branch registered in Delhi and a 2 crore branch in Maharashtra. You might think, great, both are under 5 crore. Actually, scratch that. Because they share the same PAN, your aggregate turnover is exactly 6 crore. That instantly disqualifies your entire operation from the QRMP scheme across the board.
Moving on to part 2, GSTR1 and outward supply. Now there's a golden rule that dictates this entire framework, and it's simply this. In GST, it's not sales, it's supply. According to Section 7 of the CGST Act, supply is a way broader, much more encompassing term than just your traditional sales. When you're filing your GSTR1, you're reporting outward supplies. Yes, that includes sales, but it also scoops up exchanges, transfers, and pretty much any movement of goods. It's a vital distinction to keep in the back of your mind. And let me give you a prime example of why that exact distinction matters so much. Say you move stock from your warehouse in Delhi to your own showroom in Maharashtra. Naturally, you might think, well, it's my own business, I didn't technically sell anything to anyone. But because they are in different states with different GSTNs under the same PAN, the law actually treats them as deemed distinct persons. So crazy enough, that simple internal transfer is legally considered a taxable supply. You literally have to generate a tax invoice and charge GST on it.
All right, part 3, the game of IMS and 2B.
Let's track the chronological timeline of our monthly data. On the 1st of the month, the portal opens up for your GSTR1 outward supply data. By the 11th, boom, that GSTR1 is due for monthly filers. Then, on the 14th, the real magic happens. The Invoice Management System, or IMS, and the GSTR2B are automatically generated based on exactly what your suppliers filed. Finally, everything wraps up on the 20th, which is the big due date for the GSTR3B where your actual final tax is paid. So you can really think of this newly introduced Invoice Management System as a giant waiting room or a holding pool for your incoming invoices. When a supplier files a return, their invoice lands straight in your IMS pool. And you now have 3 very simple multiple choice options. You can hit Accept, which sends that input tax credit zooming straight to your 2B. You can hit Reject if it's a clear error, or you can mark it as pending, basically holding it in the pool to deal with in a future month.
And you know what? This new system actually circles right back to answer our opening question. Before the IMS existed, GSTR2B was entirely static. It dropped on the 14th, and that was it. End of story. But today, because you are actively accepting or rejecting invoices in your IMS pool, you can actually regenerate your 2B. It fluctuates in real time based on your direct actions. So if you answered earlier that GSTR2B is a dynamic return, you nailed it. You are absolutely correct.
Which brings us to part 4, GSTR3B and tax payment.
Let's see how all this data builds into a highly complex yet incredibly common real-world scenario. Imagine this. You run a hotel in Delhi, and a business client from Haryana stays there. You punch in their Haryana GSTN at the front desk, but because it's a hotel, the place of supply legally stays pegged to the hotel's physical location, which is Delhi. Since the supplier and the place of supply are both Delhi, the system correctly charges local CGST and SGST. However, because that specific tax money goes directly to the Delhi government, the poor client back in Haryana cannot claim that credit. It flows straight into their system as ineligible ITC. It's just a fascinating, tricky quirk of navigating a destination-based dual taxation system.
Now, I've got to bust a massive myth about late fees right here. Let's say you're filing your January GSTR 3B, but you're running 5 days late. You finally submit it, you check the portal, and the late fee miraculously shows as 0. People get incredibly confused and think, wow, I got away with it. Spoiler alert, you didn't. The portal actually auto-populates that late fee into your next month's return. So your little 5-day delay in January is going to automatically ambush you as a penalty when you go to file your February return in March.
Finally, Part 5, credit notes and a major fraud alert.
So recently, the GST portal made a significant system-wide technical change. They completely delinked credit notes from their original invoices. See, originally, if you issued a credit note, you had to tie it directly to a specific past invoice number. The government removed this strict requirement to help out the medical and pharma industries. Those guys are constantly dealing with returning huge batches of expired medicines months later, often without knowing the exact original invoice. Honestly, it was a great intention, but unfortunately, it accidentally opened a massive, gaping loophole. Here is exactly how scammers are exploiting this delinking as we speak. A bad actor will issue a tiny, completely fake 50 rupee invoice to your GSTN. Then, because they no longer have to link it to a specific original value, they turn around and issue a massive 1,000 rupee credit note against you. This lands right into your IMS pool. Now, if you aren't paying close attention and you just let that fake credit note auto-accept, it artificially reduces your eligible input tax credit. They are essentially stealing your ITC through a barrage of unchecked, completely delinked credit notes. It's wild. Which leaves us with one final, incredibly provocative question. Is your GSTIN truly safe? If you aren't actively managing your dynamic IMS pool, aggressively rejecting fraudulent credit notes, and really understanding the complete journey of your outward and inward supplies, you are leaving your business incredibly vulnerable. This isn't just about simple data entry anymore. It is active, daily financial defense. I really hope this explainer empowered you to take total control of your GST compliance. Thank you so much for learning with me today, and definitely keep asking the right questions.